Hi, this is Lara at Elliott Wave Gold with your weekly analysis of oil, and after this I'll also go through the S&P 500 and gold. This is part of a new service I'm calling Lara's Weekly. Lara's Weekly is a once-a-week analysis of US oil, gold and the S&P 500. I'm designing this analysis for investors, longer-term investors and longer-term swing traders. It's currently free, but soon I'm going to be launching this as a paid subscription service. If you would like to be notified of when the subscription service will be launched, then you may give us your email address via our site. I'll put the link down below. Upon launch, we'll be offering an awesome grandfather rate for our earliest subscribers, so to make sure you don't miss out, give us your email address. The only purpose we will use your email address for is this once-off notification, and we will never be giving your address to anyone else ever or selling it for any reason whatsoever, so your information is safe with us. Okay, let's jump into the US oil analysis. Elliott Wave analysis first, classic analysis last. At the monthly chart level, the bigger picture, I have two wave counts for oil. Both of them see the end of a supercycle first wave and the start of a second wave correction here. This first wave count sees it as an incomplete zigzag subdividing 5, 3, 5, with cycle C an extending 5-wave impulse and incomplete subdividing 1, 2, 3, 4, 5. It looks now like primary 4 is complete with a slight overshoot of the upper edge of this Elliott channel. That's okay, this trend line isn't perfectly showing where price is respecting support and resistance always, so that's okay to see a little overshoot here. If primary 4 isn't complete though, and if it continues any further, then it may not move into wave 1 price territory above 74.96. At this stage, it looks very much like primary 4 is complete here. There's almost perfect proportion between the zigzag of primary 2 lasting 22 months and primary 4 lasting 23 months. Now, both zigzags, so there isn't very good alternation in structure at all, but there is alternation in depth. Primary 2 is very deep at 0.94, the length of primary 1, and primary 4 is relatively shallow at 0.47, the depth of primary wave 3. Alternation is a guideline, not a rule. It's most often seen, but you just don't always see it. That's why it's a guideline and not a rule. I think at this stage the target for primary 5 would best be calculated at intermediate degree. So when intermediate waves 1, 2, 3 and 4 within primary 5 are complete, this target will probably change, but I can't do that yet, and so I can only calculate it at either cycle or primary degree. A calculation at cycle degree doesn't work, so a calculation at primary degree is where primary 5 would equal 0.618 times the length of primary 3 at 13.39. Were primary 5 to reach only equality in length or even 1.618 the length of primary 1, it would be truncated. It's most likely to make at least a slight new low below the end of primary 3 here to avoid a truncation. Let's take a quick look at the structure of primary 4, where primary 3 low is this point down here on the weekly chart. Primary 4 subdivides as a zigzag, 5, 3, 5. Well, a B wave here, triangle, is actually 5 subwaves, but we classify it as a 3 in terms of Elliott wave. Well, it's a corrective structure. It's a running contracting triangle. For this main wave count from this low to this high, seeing this upward movement as a zigzag has a best fit. It has a much better fit than the alternate wave count at the weekly chart level. So for the main wave count, the subdivisions have a better fit. Primary 4 is most likely over, but while price remains within this Elliott channel that contains all of primary 4, we have to allow for the possibility it may not be over and it may continue further. When we have a clear breach of the channel at the weekly chart level with a full weekly candlestick below this trend line and not touching it, that would offer substantial confidence in a trend change and the end of primary 4 up here. Primary 5 would be most likely to end at least slightly below 26.86 to avoid a truncation. Let's take a look at the end of primary 4 and how primary 5 may be beginning, where this high up here is this point here. We may have an impulse down for 1. This may be a complete double zigzag up for 2. It certainly could continue higher, but at this stage it looks like it's got quite a nice proportion to a minor wave 1, and it's a very deep second wave correction. Within oil's new trends, it's very, very common for this market to have not one actually, but often more than one very deep second wave correction within the start of a new trend. So this certainly fits normal behaviour for oil. If minor 2 isn't over, and if it does continue even further, it may not move beyond the start of 1 above 66.65. It looks most likely that it could be complete here, finding resistance at the lower edge of this yellow channel, which is exactly where I had expected it to end, right at this point. That's exactly what happened. That's where price reacted and moved lower toward the end of the week. On Tuesday, Wednesday and Thursday. A target for now for minor 3 is for it to reach 1.618, the length of minor 1. If price gets down to this target and the structure is incomplete, or if price just keeps on falling through this first target, then in the text article I have a second lower target for you. So if this target is wrong, it may not be low enough. Minor wave 3 may only subdivide as an impulse. It should show an increase in momentum and it should have support from volume. At the monthly chart level, this is an alternate, still seeing the end of a supercycle first wave up here and the start of a second wave at supercycle degree, subdividing as a zigzag, but it could be complete. If we see it subdividing 5, 3, 5 with cycle wave B over here, cycle wave B here will fit as a zigzag, and within it there's a nice, possibly, 9-wave triangle for primary wave B. Primary C, if the zigzag moves beyond the end of primary A, so there's no truncation, but it doesn't move beyond the price extreme of primary B within it. That's okay. The truncation relates to where C ends, or refers to where C ends in relation to A, not where C ends in relation to the price territory of B. If cycle B is over here, and this is where we see cycle C beginning, then cycle C will subdivide very nicely as a 5-wave impulse. So supercycle wave 2 certainly could be over at the slowdown here. If that's the case, then oil would be in a huge new bull market to last several years, and cycle 3 must move beyond the end of 1. Third waves can't be truncated, and it should move substantially beyond the end of 1 to allow subsequent room for a 4th wave correction at supercycle degree to unfold and remain above first wave price territory. So a substantial bull market to move substantially above this point. Within this possible new bull market, a first wave up at cycle degree would be incomplete. I've got primary 1 and 2 and primary 3 beginning here, this low here at the weekly chart level. There's this point here, this is where primary 3 may have begun, subdividing as an impulse, 1, 2, 3 and 4 now unfolding. 4 can't move into wave 1 price territory, below 55.24. If this bullish wave count is invalidated, then we can have quite a lot of confidence in the first main bearish wave count. From this low to this high, trying to see this upward movement as a 5-wave structure really does look to be pushing it. There's such gross disproportion between minor 4 and minor 2, it looks like a 3-wave structure, not a 5. This upward movement, this piece of movement fits the main wave count better than it does this alternate. What about the technicals? How much support for that main wave count is there? Now that the month of February is complete, we can draw some conclusions about this monthly candlestick. Overall, downward movement, a lower high, a lower low. The balance of volume for the month was down, and volume did not offer as much support for the month of February's downward movement as it did for January's upward movement. So for the short term at this stage, the volume profile at the monthly chart level will remain bullish. The long lower wick on February's completed candlestick also is now bullish. So for the short term, at the monthly chart level, that looks bullish. It looks like we might not have the end of this upward movement quite yet. RSI is neutral. There's plenty of room for price to rise or fall. MACD remains bullish, and on-balance volume at the monthly chart level remains bullish. What about the short-term picture at the daily chart level for oil? The moving averages have the short-term average now negatively sloped and prices below it. The mid-term average is now flat and prices closed ever so slightly above it. The long-term average is still positively sloped and prices still below it. Prices above it. It's so far below we can't see it. The last two long lower wicks on Thursday and Friday's candlesticks are quite bullish. Friday moved price lower with a lower high and a lower low, but it doesn't have support from volume. And so for the very short term, these bullish long lower wicks and lack of support for Friday's downward movement looks like oil's probably going to have a bounce. For the short term, look for resistance now about 61.7 and prior resistance about 64.9 or just below that. Support now about 58.0 and below that about 54.50. ADX at this time frame for the previous upward trend had reached a very extreme. It's now being pulled down and the DX lines, the directional lines, are whipsawing about each other. So ADX is not yet telling us if there is a clear trend at the daily chart level. It is a lagging indicator. It's based on 14-day averages here at the daily chart level. ATR is now flattening off. For this downward movement, ATR was increasing. For this upward movement, ATR started to flatten off. We've got a little bit of downward movement this week, but ATR isn't again showing any increase. So it did support the previous downward fall in price and didn't support upward movement, which was also not supported by volume. So for the midterm, the volume profile remains bearish, but it looks like for the very short term, we're going to get a bounce early next week. No recent signals at this stage from on-balance volume. It needs to trace out a new range before we can draw some new trend lines and get some signals there. RSI neutral, room for price to rise or fall, as is stochastics moving back into neutral territory, plenty of room for price to continue falling. And what about the volatility index? What does that say? We've got a small bullish signal for Friday's session. For Friday's session, price moved lower, with a lower high and a lower low, but it hasn't come with a normal increase in market volatility. Volatility has shown some decline for Friday's session. So the decline in volatility may indicate some upward movement for Monday. So it certainly is looking like oil is going to have a bounce early next week, and then the downward trend looks likely to resume after that little bounce. We got some upward movement on Friday. That's what we were expecting. It looks like price is finding resistance at a trend line and reacting down from there. When the reaction is done, I'll expect more upward movement. Overall next week, expect an upward swing for gold. The target is at 1391. If that's wrong, that's going to be a bit too high. Elliott wave analysis first, classic analysis last. The Elliott wave count, I have a bullish and a bearish wave count for gold. I've got a total of 5 different wave counts at the weekly chart level. It's impossible for me to tell you which one is correct, and so to make the analysis manageable for me to do and digestible for you to understand, I'm going to publish one bullish and one bearish wave count every day. This bullish wave count expects that a cycle degree B wave began here. There are more than 23 possible corrective structures for a B wave, hence the great variety in Elliott wave counts possible. This bullish wave count expects cycle B as a single zigzag subdividing 5, 3, 5, and primary C as an ending expanding diagonal with a zigzag for 1, 2, 3, 4, and we need a final zigzag up for intermediate wave 5. Subdividing 5, 3, 5. I expect at this stage gold is within a consolidation for minor wave B. That's incomplete. Let's take a look at the daily chart where intermediate 4 low is down here. This point down here, so intermediate 5 subdividing as a zigzag, 5, incomplete 3. When it's done, we'll expect a 5 up. If wave A was over here, then minor wave B can't be continuing as a triangle. I can't label it A, B, C because C has moved beyond the end of A. Now I know that's possible for an expanding triangle, but in my now 10 years of daily Elliott wave analysis, I've never seen an expanding triangle unfold. In hindsight, when you can be confident of a structure, I've not seen one, so I'm not going to expect that I'm going to see one now. I'm going to expect much more common structures. Minor wave B looks like it's either a combination or a flat correction. We may have a zigzag for A, a flat for B, and then we'll need a 5 down for C if minor wave B is unfolding as a flat, or we could have a zigzag for W, the first structure in a double combination, joined by an incomplete 3 in the opposite direction, and then we'd expect a 3-wave structure for minute wave Y. Both of those options, you'll notice, for minor wave B, expect that minute wave B or X is unfolding in the same way. This looks like an incomplete, expanded flat correction, subdividing 3, 3, 5. Mini-wet wave B has moved beyond the start of A, that's normal for an expanded flat, and expanded flat corrections are really common structures. So we'll be expecting now mini-wet wave C to move substantially beyond the end of A, and most likely to exhibit a Fibonacci ratio of 1.618 times the length of mini wet wave A, so that's how I've got the target calculation 1391. But before price gets up there, there's some pretty strong resistance ahead, about 1365 and 1375. So in order for this target to be met, that resistance is going to have to be overcome, which is why I say if this target is wrong, it's going to be too high. At the weekly chart level for gold, this is still my most bearish wave count that I have. It looks at the possibility that cycle B is a flat correction, subdividing 3, 3, 5. Within it, primary wave B may be a regular flat correction, subdividing 3, 3, 5. This wave count needs a new low below 1236.54 before we can have any reasonable confidence in it. If we get that, this will be the target for intermediate wave C to reach 1.618, the length of intermediate wave A, at 958. You may notice that I'm expecting primary B as a regular flat correction, but my target for intermediate C is 1.618, the length of intermediate A, not equality with A. I'm doing that so that my target for primary wave B, when it's finally over, will be for it to meet the minimum requirement of 0.9, the length of primary A. Were intermediate wave C to only reach equality in length with A, this minimum requirement for primary B would not be met. That's why I'm using the next Fibonacci ratio in the sequence. At the weekly chart level, let's take a look at the technicals and see how gold ended the trading week. Let's make that quite a lot bigger. That's better. We've got strong support around 1305 to 1310 and resistance final about 1375. Since about here, gold has essentially been range bound in a huge consolidation, swinging from resistance to support and back again, but overall with a series of higher highs and so far higher lows. We would need to see a new swing low below this point down here, which is about 1236, in order for that overall upward trend to be changed, and then expect that gold could be in a new downward trend. So while we have that series of higher highs and higher lows at the weekly chart level, we should not be overly bearish because price at this stage has not indicated we should be. A long lower wick for this candlestick, right about support, about this strong zone here, is reasonably bullish. It looks like we've got a smaller consolidation. I'll be expecting an upward swing now to resistance, with final resistance about 1375. On balance volume, importantly this week, is at support. I'm drawing this trend line from this high, sitting just above here and just on here, now perfectly touched by on balance volume this week. With on balance volume at support and price at support, let's expect the end of this little downward swing and a new upward swing from gold. ADX this week is declining, telling us there's no clear trend. ATR overall for a very long time for gold has been showing a strong decline, might be changing. Not really, there's only about 3 or 4 weeks in it, so there's not enough here to tell us that the situation has changed and we've got a return of reasonable volatility into this market. RSI is neutral. There is plenty of room at this weekly time frame for price to fall. Stochastics is just back into neutral territory. Doesn't mean it can't move back into overbought, but also means, again, there's plenty of room for price to fall with stochastics there. I'm zooming back on the daily chart here and having a look at most of this big consolidation that gold's been in for a long time now. During this time, it's this upward day and this upward day which have strongest volume. That quite strongly suggests that for this consolidation, the bigger picture, an upward breakout might be more likely than a downward breakout. Now that trick does not always work, it just works more often than it fails. That, in conjunction with what I showed you on the weekly chart, that series of higher highs and higher lows, tells us we should overall have a little bit more of a bullish bias than a bearish bias for gold at this time frame. But price is still consolidating. Here's the smaller consolidation. We've got swings from resistance to support and back again. We've hit resistance here, about 1365. We've just slightly overshot support here, just below 1305. That's okay. Price has quickly bounced up from there. Let us now expect overall an upward swing now to about resistance. It may not move in a straight line. When price is consolidating and it swings from resistance to support and back again, it doesn't move in a straight line, so do not expect it to. That's one of the reasons why trading a consolidation is so very, very tricky and best left to experienced professionals only. For the short term, for Thursday's session, we had downward movement had support from volume. Upward movement for Friday's session does not have support from volume, so for the short term that's a bit bearish. That would possibly support the Elliott wave count that expects a little bit more downward movement for Monday. I've redrawn the resistance and support lines here for on-balance volume. It's constrained. Let's watch this carefully and look for a breakout. A break above resistance now would be a reasonable bullish signal because this trend line has now been tested about 4 times. A break below support would be a weak bearish signal because this trend line has only been tested twice. RSI is neutral. There is plenty of room here for gold price to rise or fall. ADX is declining, supporting the idea that price is consolidating. ATR flattening off also, that's normal behaviour during a consolidation. Stochastics just entered oversold, while price found support, again supports the idea that the downward swing may be over. We should be looking now for overall an upward swing. And Bollinger Band steady, very typical behaviour during when price is consolidating, and MACD still bearish. It's a lagging indicator. I was expecting some downward movement. We got a little bit, but we didn't get as much as I was expecting, and then prices moved higher and breached that channel on the hourly chart. So it looks like wave A is done and we're into a B wave bounce. B waves are the worst. They exhibit the greatest variety in structure and price behaviour. It could be a quick shallow zigzag. It could be over on Monday about 2701. Or it could take a bit longer. It could be a double zigzag. It could be a sideways combination flat or triangle. It could be as high as 2735, and it could take a few days. When the B wave is complete, I'll be expecting a C wave down, another 5-wave structure down, to end somewhere in the target zone of 2585 to 2571. When the B wave is complete, I can use the ratio between A and C to calculate a better target for you. I can't do that yet. Elliott wave analysis first, classic analysis last. At the weekly chart level, the wave count remains pretty much the same. I'm still expecting a cycled Guri fifth wave began here and is unfolding as an impulse. So far, we have 1, 2, 1, 2, 3, 4 is incomplete. Then we'll have 5 to end primary 3, another big fourth wave correction, and a final fifth wave up toward the final targets. The first target is looking now too low. That would be where cycle 5 would reach 1.618 times the length of cycle 1. If we get up to that target and the structure of cycle 5 is incomplete, or if price just keeps on going up, then we'll use the second target where cycle 5 would equal 2.618 times the length of cycle 1. Intermediate wave 4 looks like it's now incomplete. It may not move into wave 1 price territory below 2193.81, but it should find good support around the lower edge of this Elliott channel and about the 40-week or 200-day simple moving average. Let's have a look at 2 possible structures for intermediate wave 4, where intermediate wave 3 at the daily chart level has ended here. From this high to this low, this so far looks best as a 3-wave zigzag, and so this may be either wave A of a triangle or wave W of a combination. This first chart looks at a possible triangle for intermediate wave 4, with a zigzag for A, a zigzag for B, which is ended before the end of A, so this could be a regular contracting or regular barrier triangle. Then I'll expect a zigzag or single or double zigzag down for C, which may not move beyond the end of A, not even the slightest amount for both regular or contracting or barrier triangle. C may not move below 2532.69. When C is complete, we'll expect another 3-wave structure up for D, which may not move beyond the end of B, above 2789.15 for a contracting triangle, and for a barrier triangle should end about the same level as B, so that the BD trend line remains essentially flat. In practice, that means that D can end very slightly above the end of B and a triangle will remain valid. When D is complete, a final little zigzag down for E would be most likely to fall short of the AC trend line, and that could be the completion of an intermediate degree 4th wave triangle. Let's have a look at another option where the end of intermediate 3 is the same. There's this point up here. Now we're looking at the second structure I can see continuing for intermediate 4, that of a double combination. The first structure in the double may be a complete zigzag labelled minor wave W. The double may be joined by a 3 in the opposite direction labelled X, and minor wave Y would be most likely by quite a wide margin to be a flat. It could also be a triangle. Let's assume the most common structure for minor wave Y. Within double combinations, the combination of one zigzag and one flat correction is extremely common. It's actually quite rare in my experience to see a zigzag in a triangle. So minor wave Y is likely by quite a wide margin to be a flat correction if intermediate wave 4 is continuing sideways as a combination. A flat will subdivide 3, 3, 5. The most common type of flat would include minute B moving beyond the start of A as in an expanded flat, and then minute C moving substantially beyond the end of A. The purpose of combinations is to take up time and move price sideways. To achieve that sideways look, the second structure in the double usually ends pretty close to the same level as the first, so this wave count would expect minor wave Y to end close to the end of minor W at 2532.69. I think this combination idea may be a little bit less likely because it would require quite a good overshoot of the 200-day moving average to see minor wave Y end down at that point, and I think we should expect in the first instance strong support at the 200-day moving average until proven otherwise. Let's have a look at the classic analysis now, and let's make that a bit bigger. This weekly candlestick completes a strong outside week, a slightly longer lower wick than upper wick, but it's not enough to say that it's overly bullish. During this week, the balance of volume was down, and there's support from volume for downward movement within this week, so that's a bearish candlestick despite the new highs. On balance, volume has still got a little bit of room to go before it's going to find support, and if it does get down to this yellow support line, that may assist to halt the fall in price here for the S&P. RSI is neutral. There is plenty of room for price to rise or fall. This consolidation or pullback has managed to bring RSI back from extremely overbought and ADX down from showing a very extreme previous upward trend. And so there is again, when the pullback or consolidation is complete, there will again be plenty of room for a new trend now to develop. MACD still bearish. What about the short-term picture on the daily chart for the technicals? Friday's candlestick completes a bullish piercing pattern. It's a reasonable reversal pattern. It's not the strongest, that would be a bullish engulfing, but it is a reasonable reversal pattern coming after these 3 good strong downward days. There's some resistance here about 2700 if price manages to break through that, and there's some resistance here about 2770 and support below about 2600. This downward movement for 3 days in a row had good strong support from volume, and now for Friday's session the balance in volume is upward and we've got lighter volume. So this is a bullish reversal pattern, but it doesn't have good support from volume for the very short term. Now that certainly could change. Monday could be a stronger upward day, and if it has support from volume we'll expect the bounce to continue, but for now, that with the data we have in hand after the session for Friday has closed, upward movement during Friday's session does not have support from volume, and so let's expect in the first instance that this bounce may be a little bit weaker and more short-lived, and that would tend to favour the Elliott wave count that sees this bounce at the end of Friday's session as a B wave within a continuing downward zigzag. B waves should exhibit some weakness. ADX is very slightly increasing. It's now telling us there may be a downward trend again in place. Overall, ATR is now flat as price is essentially moving sideways in a consolidation. That's fairly normal for ATR to behave like that when price consolidates. I've drawn a new support line here for on-balance volume. I shan't read this as a bullish signal because the line is only just able to be drawn. If on-balance volume can break below this line, it would be a weak bearish signal. If it breaks below this line, that would be another weak bearish signal. Weak only because these lines have not been very often tested. RSI is neutral. Stochastics is again neutral. Plenty of room for price to rise or fall. MACD just given a bearish crossover. And Bollinger Band's contracting as price now essentially moves sideways, quite normal for either a consolidation or possibly the start of a new trend. What about VIX and the AD line? Because they've been reasonably reliable in the signals they've been giving lately. As price moved higher within Friday's session, inverted VIX has moved higher. The rise in price during Friday's session has come with a normal corresponding decline in market volatility, so we'll read that as bullish. And also the AD line. Upward movement during Friday's session has support from improving market breadth. Let's read that as bullish. So let's expect a little bit more upward movement, at least for Monday. It just remains to be seen how high it's going to go and how long that bounce is going to last. I hope that our members and viewers are having a most fabulous weekend.